When it comes to investing, numbers and charts might look objective, but emotions and psychology often drive more decisions than we realize. Every investor, no matter how experienced, falls prey to common cognitive biases that quietly influence financial choices, and two of the biggest culprits are herd mentality and overconfidence. Let's break them down and learn how to avoid them. Herd mentality is the tendency to follow the crowd, assuming that if everyone is buying or selling a stock, it must be the right move. It's that powerful psychological urge to belong and not miss out, what's often called FOMO, or the fear of missing out. Think of the 2021 GameStop rally, or crypto booms, where millions rushed in because others were making quick money. The result? Many investors bought at inflated prices and suffered losses once the hype faded. Herd behavior clouds judgment because it replaces research and logic with emotion and social proof. The first step to overcoming it is awareness. Recognize that popularity doesn't equal profitability. Before you invest, ask yourself, am I convinced by fundamentals or just following others? Always back your decisions with facts. Look at company earnings, market trends, and long-term data rather than social media hype or group chat advice. Remember, by the time everyone's talking about an opportunity, it's probably too late to benefit from it. Now, the second big bias, overconfidence. This happens when investors believe they know more than they actually do. Overconfident investors tend to take excessive risks, trade too frequently, or ignore warning signs because they think they can beat the market. Studies have shown that overconfident traders often underperform those who simply invest steadily and diversify. Confidence is good, but unchecked confidence is dangerous. It leads to ignoring diversification, overestimating short-term trends, and mistaking luck for skill. To avoid this bias, build a habit of humility. Keep a trading journal to track your decisions and analyze what worked or didn't. Often you'll find that emotional impulses, not logic, drove your biggest mistakes. Set strict risk limits, diversify your portfolio, and avoid making investment choices when you're euphoric or fearful. Those are the worst emotional states for rational judgment. Other subtle biases also creep in. Confirmation bias, where we only seek information that supports our beliefs. And loss aversion, where we fear losing more than we value gaining. These cause us to hold on to bad investments for too long or miss new opportunities. The antidote is objectivity. Review your portfolio periodically with a neutral lens. And don't be afraid to admit when you're wrong. Sometimes, the smartest financial move is to cut your losses and move on. At the end of the day, successful investing isn't just about numbers. It's about mastering your mindset. If you can control your emotions, challenge your assumptions, and make decisions based on data instead of hype, you're already ahead of most investors. So next time you see a crowd rushing into the next big thing, pause, take a breath, and ask yourself, is this logic or herd mentality? And when you feel too certain about your picks, remind yourself, even the best investors get it wrong sometimes. Balance confidence with caution, curiosity with discipline, and emotion with analysis. That's how you build not just a portfolio that grows, but one that lasts.